Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that can completely change how you think about investing. It's a strategy so simple, yet so powerful, that it can help you build wealth over time, even if you don't have a ton of money to start with. I'm talking about dollar cost averaging, or DCA for short. If you've ever felt intimidated by the stock market, worried about timing your investments perfectly, or just don't know where to begin, then this video is for you. We're going to break down exactly what DCA is, how it works, why it's so effective, and how you can start using it today to secure your financial future. Stick around, because this might just be the most important investment lesson you'll learn. So, what exactly is dollar cost averaging? Let's strip away all the complicated jargon. At its core, DCA is the practice of investing a fixed amount of money into a particular asset at regular intervals, regardless of the asset's price. Think of it like putting your investments on autopilot. Instead of trying to be a market genius and predict the perfect moment to buy what we call timing the market, you commit to a consistent schedule. This could be investing $100 every Friday, $500 on the first of every month, or even $50 with every paycheck. The key words here are fixed amount and regular intervals. The magic of this strategy isn't about being smarter than the market, it's about being more disciplined. By investing consistently, you remove the guesswork and emotion from your financial decisions, which, as we'll see, is a massive advantage. Now, let's get into the how and why this works so well. Imagine you've decided to invest $100 every month into a specific stock or fund. Let's call it Awesome Tech Inc. In the first month, the share price is $10. Your $100 buys you exactly 10 shares. Easy enough. The next month, the market dips, and the price of Awesome Tech drops to $5 per share. Now, your same $100 investment buys you 20 shares. See what happened there? When the price was low, your fixed dollar amount automatically bought you more shares. In the third month, the market recovers, and the price shoots up to $20 per share. This time, your $100 only buys you 5 shares. Over these 3 months, you've invested a total of $300 and acquired 35 shares. Your average cost per share is your total investment divided by your total shares, which comes out to about $8.57. Notice how your average cost is lower than the initial price of $10 and much lower than the peak price of $20. This is the core benefit of DCA. It helps you smooth out the average price you pay for your investments over time. You automatically buy more when prices are low and less when prices are high. This removes the stress of trying to buy at the absolute bottom, a feat that even professional investors rarely achieve consistently. One of the biggest psychological hurdles in investing is fear and greed. When the market is crashing, our natural instinct is to panic and sell. When it's soaring, the fear of missing out, or FOMO, tempts us to pile in at the top. Dollar cost averaging acts as a powerful emotional circuit breaker. Because you have a preset plan to invest a certain amount on a certain date, you just follow the plan. Market's down? Great, my money buys more this month. Market's up? Great, my existing portfolio is worth more. This systematic approach takes the emotional roller coaster out of the equation. It forces you to be disciplined, which is arguably the most important trait of a successful long-term investor. It turns market volatility, something most people fear, into your friend. Every dip becomes an opportunity to lower your average cost, setting you up for greater potential returns when the market eventually recovers, which historically, it always has. So, who is dollar cost averaging for? Honestly, it's for almost everyone, but it's especially perfect for a few groups of people. First, it's ideal for new investors. If you're just starting out, the idea of investing a large lump sum can be terrifying. DCA allows you to dip your toes in the water and build your portfolio gradually. Second, it's perfect for anyone who invests with their regular income, like from a paycheck. Most people don't have a giant pile of cash sitting around waiting to be invested. DCA aligns perfectly with how most of us earn and save money in steady, periodic amounts. This is why it's the default strategy for retirement accounts like 401ks and IRAs. A portion of your paycheck is automatically invested every pay period, implementing DCA without you even having to think about it. It's a set-it-and-forget-it approach to building long-term wealth. Now, let's talk about how to put this into practice. It's surprisingly simple. The first step is to decide how much you can comfortably invest on a regular basis. Be realistic here. consistency is more important than the amount. It is better to invest $50 a month without fail than to invest $500 one month and then nothing for the next 6. Look at your budget and find an amount that you won't miss too much. Step 2 is to choose your investment vehicle. For most people, especially beginners, a low-cost, broad market index fund or ETF is a fantastic choice. These funds give you instant diversification by holding hundreds or even thousands of different stocks, spreading out your risk. The S&P 500 Index Fund is a classic example. Step 3 is to automate the process. This is the secret sauce. Almost every modern brokerage platform allows you to set up automatic, recurring investments. You can literally tell it, transfer $100 from my bank account and invest it into this fund on the 1st of every month. Set this up once, and the system does the hard work for you. It ensures you stick to the plan, even when you get busy or when your emotions might tempt you to do otherwise. It's also important to understand what DCA is not. It's not a get-rich-quick scheme. It's a long-term strategy designed for patient wealth accumulation. You won't see dramatic results overnight. This is about playing the long game. Also, DCA doesn't guarantee a profit or protect you against loss. If you invest in a fundamentally bad company that goes to zero, you'll still lose your money. That's why your choice of what to invest in, like a diversified index fund, is so crucial. The strategy works best with broad market assets that have a long history of upward growth over time, despite short-term volatility. There's also a debate about DCA versus lump sum investing. If you suddenly come into a large amount of money, say from an inheritance, studies have shown that, historically, investing it all at once has led to slightly better returns on average. Why? Because the market tends to go up over time, so getting your money in sooner gives it more time to grow. However, this also exposes you to the risk of investing right before a major market crash. For many, the psychological benefit of DCA, the peace of mind it provides by spreading out the risk, far outweighs the potential for slightly lower returns. It helps you sleep at night, and you can't put a price on that. Let's wrap this up with a final thought. The single biggest barrier to building wealth for most people isn't a lack of knowledge or a lack of money. It's a lack of action caused by fear and indecision. We wait for the perfect time to invest, a time that never comes. Dollar cost averaging shatters that barrier. It gives you a simple, actionable plan that you can start right now, today. It's a commitment to your future self. By investing small amounts consistently over a long period, you harness the power of compounding and turn market volatility into an advantage. You don't need to be an expert. You don't need to be rich, and you don't need to time the market. You just need to be consistent. Start small, stay disciplined, and let time do the heavy lifting. Thank you so much for watching. I hope this breakdown of dollar cost averaging has demystified the process of investing for you. If you found this helpful, please hit that like button and consider subscribing for more content on personal finance and investing. And I'd love to hear from you in the comments. Are you already using DCA? Or are you thinking about starting? Let's get a conversation going. Thanks again. And I'll see you in the next video.